right? We went ahead and we did our journal entries. Then we went ahead and we posted everything to the general ledger. Then after posting to the general ledger, we went and we closed it on the, we went up and we put the adjusting entries in our journal as well. Then we came up with our trial balance, okay? So now that we're at our trial balance and we've done our adjusting entries, notice the key is we've done our adjusting entries, then we did, and we performed the information that we needed to. We entered all the information into our adjusting trial balance, making sure that everything again balances out. And now what we're doing is we're actually going to start doing the income statements and the owner's equity and the balance sheet. This shouldn't be that big of a thing to do. And then we're going to show you what we've got to do for the post-closing trial balance. Because it's not just creating the trial balance here. It's also going back through each ledger and posting it into, making sure that you make the entries to post into the income summary. Remember that we talked about on Monday? It's everything that, it's like a holding area, a holding tank that takes everything. So that's what we're going to be doing. Now remember that the formats for the trial balance, the income statement, the statement of owner's equity, and the balance sheet can be found in your page on in your book on page 46. Okay?
And also in this video.
And also in this video, yes. So we're going to do that. So what we're going to do is we're going to start with the income statement. Now, in the income statement, again, yes, I'm going to drill this into your heads until the cows come home. Right now they're out on vacation in Tampa, Florida, looking for the cat, the big tiger.
Looking for the toy
They'll
again.
be back after a while. But what we're going to do, though, is we're going to do and set up the income statement. And the income statement, remember, it is your revenue that we get from the balance in your ledger. You have your revenue, then you have your expenses. So we go ahead and we say for the month of January ending at whatever year, you're going to have first your revenue, whatever the revenue is. And for this assignment, what were we looking at as far as revenue based on our chart of accounts? It was plowing fees. Okay? Then, from here, you're going to go find that information from your ledger, which would be 5?
I think it's 2.
2?
Make it 3.
Okay.
Yeah, right there.
3. So notice, this we go ahead and we find out how much we had, and remember this is your running balance right here. So our fees were $13,000. Now you can find it from the ledger, or you should also be able to find it where? In your worksheet, correct. So we're going to place that into your income statement for $13,000 right there. Now what we're going to do...
Hang on, pause real quick.
Oh.
And now, when if you all get this sort of fancy looking text that you don't like, that doesn't show all the nice numbers, you're going to highlight everything. I usually highlight all the columns here. You're going to go up here to your home tab where it says number down here. You're going to go ahead and hit the drop down arrow, and you're going to go ahead and click text. So that'll fix
everything
that you're going to have. And now also adding to what Dr. Claus was saying is that the plowing fees, the reason why it's thrown over here onto this right side column is because that's the final total column for all the accounts that you're going to be putting in there.
Yes, and remember, that is also the format for the income statement, plus then all of the expenses are going to be totaled here on the left-hand column, right there where Jose shaded it. That's where we're going to have all of the expenses. And they're called operating expenses because they're all the expenses that we use within the company. All of the expenses that we have. So, if we look at our chart of accounts, you're going to see that your expenses are your salary expense. We're going to type that in. Hello?
Like
there's a delay there? What?
It's like it had to register through the mic.
There you go. We had a salaries expense. You also had an advertising expense. And then you had a telephone expense. And I'm not making this up. This is found on page 179 of your book. You also had a rent expense. Yep, snow supplies. And then remember, do not forget your depreciation expense as well, because we're bringing down the value of the equipment, both your office equipment and your snow equipment. So we have to put those in as well. Okay, we're missing Mira, Ricardo, Erica. Who else? That's it, right?
Yes, it's the one that we're continuing on from last time. 583. Alright, class, then what is our total salaries expense?
Where do we find that?
What's the cost of our salaries expense that we've paid so far for this month?
What's our balance that we paid? Where do you find it?
No, I don't know.
Come on, I don't know. Do we need
Yes.
coffee?
So then, yeah, go to your worksheet. Tell me what it is.
What?
What?
Salary expense, I thought you were talking about.
No.
I'm like, excuse me, what?
I don't need the total of all your columns now.
No. Just the Mira, wake up. Take a peppermint. Okay.
All right, I'll give you this
I
one.
hate mint too.
Then I don't know what to do for you, sir. And then we're going to take also the advertising expense. Okay?
So now, the best place you can find these expenses will more than likely be in your ledgers, because we've already updated our ledgers,
Updated ledgers,
to
right.
the most recent
Recent.
transactions. So that's the best place you can find it. I know it's going to be kind of a headache because you're going to be going back and forth from all the ledgers, but that's just the poison that you pick when you take this class.
Excuse me, what do you mean poison?
Alright. I don't know.
I don't have any poison in my class.
But yeah, advertising expense. Usually all the expenses will be towards the end of
Toward
your
the
ledgers.
end, yes.
So we're going to be going back and forth from 4 and 5. So advertising expense shows a total of $800,
$800.
right?
So we're going to put that in.
You come back and go ahead and put that right there. Right there. And if you didn't notice, when you go back to ledger 4, they actually go in order.
In order. So
So
you see them.
if you lose the formatting on how to make this, all you have to do is just follow. You have to remember what comes out in the income statement, and then just follow the pattern that they give you in your ledgers.
For your expenses.
Correct. And now the next one would be telephone expense, right? For $140.
Yep.
So we just go ahead and put $140 right there. Rent expense, is rent expense still in here? Yes, it is. Rent, snow supplies as well. So rent is $400 and snow supplies expense is $200. See if I can remember that all the way over here. Snow supplies, $200, right? And then finally the depreciation expenses, which are in our last part of the ledger,
Ledger 5.
which is going to be $200 for office equipment and $170 for snow equipment. You got to be very careful with those. So how much was it? It was $200 for the first one,
Yep. And then 170.
and then $170 for snow equipment. Now what you have to do next is you would basically come over here and put total operating expenses, and then you would total out all these expenses and then actually add it up here. Has anyone done that yet? Technically you already have it because we've done the income statement actually already on the worksheet.
Yep.
8740.
What is 8740? Is that my total operating expenses?
Oh, yeah, no, sorry. I thought you were-
Yeah.
Don't jump ahead of me now.
426.
It's $4,260, right? Total operating expenses.
Correct.
So now the one thing So then what are we doing here on the income statement right here? What are we doing with these two numbers? Are we adding them, subtracting them, multiplying them, dividing them?
No, we're not gonna find the square root.
Slick, but no.
Look, we're not.
We're subtracting.
Yeah, we're subtracting because remember, what are we trying to do? Our goal is to find out, did we make any money this month? After all our expenses, did we make any money?
So did
So
we?
we need to remember to subtract our total operating expenses from our net income for the month,
Well, the money that we've earned.
or that money that we've earned.
And usually if the money that we've earned is bigger than the money that we used, it shows what?
A net income or
Net
profit,
income.
yes.
You're making money, money, money.
Well, this is the guy
What is
that
that
went ahead
amount?
and took out the 8,000, right? No.
What's that amount? And the amount is what?
How much?
8740. That is correct.
That's correct. Oh yeah, this is the guy that took $8,000 out, right?
Yes.
Beanbag. Anyway, sorry. My own personal thoughts here. Sorry.
He's a fictional character.
I know he's a fictional character, but it's a bad example.
It's bad practice.
Bad practice.
And so now you're essentially complete with your income statement.
Yep, that's the income statement. Now remember, we're going to be using this number right here, this net income. We're going to be using that in our owner's equity. Okay? So let's go ahead and begin now. Remember to save. Okay? Because even though it didn't rain and they told us it was going to rain, we still have a bunch of dirt out there, and any little amount of moisture will make the transformer go poof.
I was already ready for Noah's Ark to come by, but
I know.
it never rained. So.
I had rain boots and everything. Pero nada. So here we go. Owner's equity. The format for owner's equity, remember, we're going to be having what? We have the capital, the beginning historical capital for this person. And who is this guy?
Okay.
Well, his name's
Pat Plowing. So anyway, we have his original capital. And how much did he start this with? 26,200, because remember that was what he invested January 1st. That's the historical value. Then what we do after that is we put in then what? The net income for that month. So net income for January 31st.
We just have it looking ugly here until they put first up.
Wait, hold on. You didn't put the total.
Well, nobody told me what it was.
I don't have to total in you. You know that this has to go over here.
Okay.
You're the tutor.
Okay, fine. I'll give you all the numbers then.
Wait a minute. We have to fix
So
that
then here's
too.
this
Here we
once
go.
again. This is nightmare again. You go to Home tab. Go ahead and go to that little drop down arrow. Click Text, and everything's fine and dandy again. So he did a total investment at the beginning of January as $26,200.
Right.
Okay.
So now we're taking the net income from the income statement, which is 8,740, and we're going to be putting that there.
And you'll put it here on the inside column because there's
Right in
still
here.
going to be some math, possibly, that will happen here in this financial statement.
The other thing that we've got to put in then is we have then also less the withdrawals. Remember that the reason that we're putting in less the withdrawal is because he took it for personal use. It is not an operating expense because it has nothing to do with the business. So he decided to take the $8,000 out. So now what you're going to do is you're going to, here on this other end, you're going to go ahead and bring the total, whether there was an increase or a decrease in capital. So what we're going to do here is we're going to subtract then the 8,000 from the 8,740. So actually the only amount that he made was an increase of capital of $740. That's it. So his new, even though he made money because of his I was gonna say something but I won't. Because of what he did, now we see that there was an increase in capital. So now what we're going to show on that format is now the increase in capital for him based on January the 31st, because this is the end, and we're gonna show the total. So you're going to end up adding 26,200 to the $740, bringing our new total to $26,940. An increase of capital in the month of January.
So now we're technically finished with the statement of owner's equity. So now we then transfer over to the balance sheet. But don't forget, you're going to need to take this number
Right.
and transfer it over to the balance sheet.
Each one needs the other.
Income
Okay?
statement. Owner's equity can't live without income statement because you need to take the net income out of income statement to calculate for the rest of it. And then you also need to take that final number that you get out of the statement of owner's equity and move that
Into the balance sheet.
into the balance sheet. More specifically onto the liabilities and owner's equity area.
Correct. So now what you're going to see then is we're going to start setting it up. Remember, you already have this kind of set up where you're going to have all your assets and then all your liabilities and your owner's equity. And on your assets, okay, what do we have as far as assets? If you look at your chart of accounts on page 170, you're going to have them there. And then you're going to total them out. You can start setting it up by saying that you have your cash. What happened? Oh, there it is. Ooh. You have your cash. You have accounts receivable. Okay,
I just need to learn how to type again.
there you go. Prepaid rent. Now, a lot of people ask, why is an accounts receivable considered an asset? Because it's money that is owed to you, either on schedule or if something happens, you can ask for it ahead of time. Prepaid rent is because you've got money set aside. You've got your snow supplies. Then you also have your office equipment. You could always sell it if you need to. Your accumulated depreciation is still showing your depreciation on your office equipment. Then you put in your snow equipment and your accumulated depreciation of your snow equipment. The reason that you put the accumulated depreciation is because in an audit you have to show also on those big ticket accounts how much of use you've had on those assets. If you had a delivery truck, how much have you used it in order to go ahead and show the auditor. So now all we're doing then is bringing in the totals from the ledgers over to the asset side. So in cash, what was our total? If we go up now, ledger 1 will show you all the information, and typically in ledger 1 you're going to see all of your assets. So our final balance is, from the running balance that we have here, is $4,960. So that's what you're going to be putting into your balance sheet.
And since it's the final number, you're gonna here it goes again. Since it's the final number, you're gonna go ahead and just put that on the right side column. Just to remind y'all that the reason why there's two columns here on either side is because the right one's going to be the total column, the final numbers. Why does that look weird? And the inside column is going to be the one where you're going to do some subtotaling in order to get the final numbers, and you're going to throw those over to the right side column to make it look fancy.
And that's the format of the balance sheet, and that's going to be based on the owner's equity. Okay, so now we're going to be putting in all of our balances there. Okay, so we have cash.
Yeah,
What's going on?
there was an extra bar.
Yeah, those are an extra little,
Oh,
but we're good now.
how? An extra bar.
Extra bar. Extra bar in case for the YouTubers.
The YouTubers. You mean the online class? They already think we're strange. Okay.
They don't even know me. They
We're
don't even
strange.
met me.
Some of them do.
All right, class. For accounts receivable, what'd you get there? And see, the other thing that you can notice is that the way we wrote them down is the same way that they're in the ledgers.
Right.
So that
Right.
helps you a lot more in the organization part of it, and also just finding the numbers themselves, because if they were just jumbled around, you'd just be losing your hair, you'd be pulling your hair out every time you'd be looking at this stuff. So accounts receivable
Was 5,000.
and somebody owes you some money.
Mm-hmm.
And since it's the final number, there was no other math that we have to do for accounts receivable. It just goes straight over to the right side column.
And for prepaid rent, remember it's going to be less the amount of money that we already showed. So prepaid rent ends up being what? $2,000, because we already used up $400 of that rent.
Because we showed that adjustment earlier in this program. And then the next one is snow supplies. And we did an adjustment there the last time too, at the end of this month, right? So all we have left is $100 on hand, right?
Please, please remember, on hand. Please remember that, because that's what the kind of errors that I'm seeing, is that instead of subtracting the amount that was used, okay, or finding out the amount that was used, instead what's happening is that we're actually putting in the other. Okay, and we're putting in the on hand. So for example, I think in this one we had what, $300?
Yes, we initially had $300
$300 at the beginning.
for initial investment, right?
And then it said that we had $100 on hand. So in order to find out how much was used, you subtract the on hand amount, and then you end up with $200. This is the way you know how you came up with only $100 on hand. And this is of what equipment or what?
There's no supplies.
Snow supplies. Okay? Snow supplies. So you used it up. So this is how you find out how much you have left over, how much you've used, and why you're having on hand. So they're subtracting the on hand to now get the $200. So please remember that, because a lot of them, what they were doing was leaving the $200 instead of the $100 as far as the adjustment. So please be careful with that. The verbiage, I said, is what was going to be very difficult for you guys to not only understand, but to remember as well. Okay? So, now we're going to go ahead and show that we only have $100 on hand. Yes, go ahead.
Do we need to put the snow equipment on there as well?
It's right here.
Right there, mate.
Yes, we do. But
But the best way I can remember to help y'all with that snow supplies thing is that $100 on hand, which is still
Right
in
here.
your hand, which is left in your hand.
you still have it.
You had $300 before, now you only have $100.
Yep.
And then off to the next one, which is office equipment. So now we're at the end of the road for ledger 1. So just go ahead and go to ledger 2, and what do you know? It's right there. The next one, right?
Now, in order to go ahead and put this in, remember, this week we purchased, and we purchased it on the count. But the thing is, though, is that this is the historical value of the office equipment, which still needs to be stated in your balance sheet as far as an asset. So you're always going to put in the historical amount. So we're going to put in then the $1,200. Then what we're going to do is we're going to show what? The fact that we took off the depreciation on the snow equipment of $200. So here's the $200 here. Can you bring column A over, please? To make it just
Yes.
a little cleaner. The equipment.
It lets me. There we go.
There you go. And notice, once we go ahead and have this total, then we bring the amount here. We're going to show how much it is. So instead of having then the $1,200, we now have $12,000. We now have how much? 11,000 what? 800. Again, because you still have the asset, but you're showing the use. Okay?
And now one thing to add on that is that the reason why you don't touch the historical value in your ledgers is because of that. It's the historical value. Like you're showing that you paid that much for that equipment. Now the reason why you basically decrease it here in in the balance sheet is because this is the financial statement. So you're gonna have to actually formally show to the government, to the IRS, whoever else wants to see your financial statements, that you had this much of value for your equipment, but it's been depreciated by this much, and now the value now is this much.
It's the same thing with a car. When you drive it off the lot, if you pay $26,000, as soon as you drive it off the lot, it starts to decrease in value. So that's why at the end of so many years, you go to what is considered Kelly Blue Book, and they have it online now. And you put it in and you say, hey, this is how much I paid for it, this is how many miles I have on it, and this is what it looks like as far as good or fair condition. And then you go ahead and you get your value. Now, on a delivery truck or anything like that, you're going to show how much you're going to depreciate it over the amount of years that you have it. So this that we came up with, as far as $200 a month, is to go ahead and show how many years we decided to do this, and to also show how much we're going to take off per year. Okay? Same thing with the snow equipment. In the snow equipment, how much was its original value? It was $10,200, right? Original value. So we put that in the balance sheet. Minus the depreciation amount, which was $170.
And now another thing to add, in case there's any questions there, is that why is the cumulative depreciation a credit and not a debit like the asset of snow equipment or office equipment? It's because accumulated depreciation is a contra asset account, and meaning by that, the first part is contra, like it's the opposite or contradicting. So it's going to be it'll always be the opposite of what originally the account is. So snow equipment is a asset having a debit increasing side and a credit decreasing side. So the sides will just be flipped when it comes to showing the values. So the credit for accumulated depreciation shows an increase in devaluement, versus where the debit side for snow equipment shows that it's $10,200 in value initially, historically.
Correct.
That's just a little side note.
So now we put in the snow equipment value after the depreciation, which is what? 10,030?
Yes.
And now, on this side, we're then going to go ahead and put in our total assets. Now remember, this is a balance sheet, which means that with the liabilities and the owner's equity, we're going to come up with the same amount of money here. So what is our total on this end after we total all of this up? Excuse me.
What is it, mathematicians? That was not purposeful. I was actually stuttering. You couldn't get the M out.
You couldn't get the M out?
I couldn't get the M out.
Okay.
Loud and proud. Louder.
No, we have to go. We hear Shimoniak. Dead people hear Shimoniak again, right next door. We can't hear you.
No, my online class right now is hearing it right now.
Exactly.
That is correct. 33,890 is your number there, and that's the correct number you have. So now we just got to get the other side to look with the same numbers.
Now, on your own, the other side of the balance sheet, the first thing that we're going to put in are the liabilities. Okay. And on the liabilities, again, you can go by what you've got in your chart of accounts or your ledgers. Your liabilities are two. You have accounts payable and you have salaries payable. And again, I'm getting that off of page 179 where it says chart of accounts. And it's in your ledgers as well.
In order, of course.
Of course. So your accounts payable, notice this is how much money we owe, which is $6,800 for the accounts payable.
So then we go ahead and we put in the specific title accounts payable, and then the amount that we owe, $6,800. And now the reason why I'm putting it on the inner column, if you notice that, is because we also have
Salaries payable.
that additional one. Yes, salaries payable. And where was that? Ledger 3. It was salaries payable.
$150.
$150. $150.
Matter what order we put this in?
Actually, yes. In your chart of accounts, accounts payable is first because it's a 211, and then salaries payable is 212.
So when we look at the capital first, and then those liabilities.
No, you would have to put in the liabilities first because that's the format for the financial statement. You're gonna freak out your accountant if you do that, or your auditor.
This is any needs for aesthetics.
So it's owner's equity. Next. Oh, we already put the total, right?
Yes, I've already done the calculation for the total because we've learned that this inner column is the subtotaling. So you just take the math, and this time we're gonna add them because they're both in the same respects of we owing that, and then we just go ahead and total them out and have that new number of how much we owe somebody or people plural.
Yep.
So now that capital, what did I say earlier about this capital?
Which one do we get it from?
don't know.
The
just say it again, right?
Statement of owner's equity.
Correct.
So we're going to come back into the statement of owner's equity, look at our capital for the end of that month, and you're going to go ahead and remember it, or
Know where to find it.
yeah, figure that out, and then just come back over here and just type it in, 26,940, correct?
Yep.
And then that's it. All we do is just do the math.
Now we do the math. Total liabilities and owner's equity.
And then what do you get? What do you get when you do add these two numbers up together?
33,
Yep.
You
You balance.
should get the same number, or you should, as what Dr. Claus said, balance.
You should balance. If you do not balance,
Something's wrong.
something's wrong. You can actually at times subtract the two amounts, and sometimes you'll be able to find exactly how much you're off and be able to find it. Okay, to find out how much you're off. If you were to do this instead and use this instead of the other one, you'd actually be off by $100. And that's not what you want to do. You want to make sure that everything balances out the way it's supposed to. Okay? So now that we've done, please save your work. Now that we've done this, we're going to do our not our post-closing, but now what we're going to do is we're going to do what we said that we were going to do, which we have to do, which is now closing. And our closing entries, everything has to go into what? Income summary. That's what we talked about. So you're going to have, if you remember correctly, and if I remember correctly, that's the most important, making sure that I remember. On your income, on your closing entries, we're taking the ledgers and we're actually closing them out. Now, the accounts that we're closing up are which ones that we said? Which ones are the temporary accounts? Like, I don't know, I don't remember. Which ones are our temporary accounts?
revenue
Yes, that's one. Revenue's
That's one.
and expenses.
Correct. That's two. We need one more.
One more.
One more temporary account. Right now we have revenue and expenses. There's one more account that we've done. No, that's not temporary. That's a permanent account. Capital will always be a permanent account.
Temporary accounts. You said what? We said it was going to be what?
Withdrawals.
There you
Yes.
go. Well, that's our third one, withdrawals. Rock out.
You have withdrawals. Can I never spell that correct? Expenses.
Bless you.
Bless you.
And what did we say? Revenue.
Yes.
Our permanent accounts then are which ones?
Everything else.
Everything else. Which is? Capital. Your payables or your liabilities, right?
Cash.
Cash. And the reason, unless you go under, then it's not a permanent account anymore, right? All your assets are permanent. These are the ones that we're going to close out. These are the ones that we have to make sure that we're closing out. So what we're going to do then is, in order, we're going to begin to do this. Now, this is what the fun part is, right? We're going to first
Close revenue.
close the revenue. No,
Yes.
no,
Yes.
no.
Yes.
Oh, yes. Sorry. Okay. So what we're going to do now is we're going to go ahead and have this placeholder right here, which is called income summary. That's your account, right? We're going to
Yes.
do each one, right?
Yes. 'Cause initially, you're gonna have to close your revenue first. However, you have to remember how the normal balances look for those accounts. So initially, the increasing side for revenue is what? Debit or credit? Spoiler alert, it's credit. So, if you're always increasing credit during the month, now you're wanting to close it, you're going to have to do the exact opposite in order to make it zero. So what you're going to show here on your general journal is plowing fees, which is our revenue account for this transaction, and you're going to debit this account for whatever amount we had for revenue. And how much was it? Does anybody remember?
What?
It's 13,000. 13,000 is
13,000.
the amount of revenue that we earned for the month of January. And now what we're doing now with it is we're zeroing it out in order to show what we did already in our financial statements and in our worksheet, which was, I'm sorry, what am I saying?
Really?
Yes, it's to basically show how much we've earned and what we've made and used up within our journals and ledgers. So by closing out plowing fees or zeroing it out, debiting it, we're going to credit it then to that fancy account that Dr. Claus said that
Income
was
summary.
income summary. And now for the students that are still kind of questioning income summary is essentially just kind of like a holding
Holding
cell,
tank.
because it doesn't necessarily have a normal balance. It has a normal balance in the sense that whatever the two amounts that are in there will determine if you made money or did not make money. And I'll explain that more as we get to the next part of the income summary. So we're closing out, we're going to go ahead and put our explanation as closing out the revenue account.
Which is actually what we're doing.
Revenue account. And now do you want to go ahead and do it one by one and actually do it through the ledgers as well? For this one, because it's real simple?
Yeah, let's do this one. And now once you do this, okay, once you've done this one, then you have to go to your ledger and close it out there as well.
So the first account we're going to look for is plowing fees, and I believe plowing fees was in the third
Three.
ledger, right?
Yeah.
Yes.
So we're going to go ahead and scroll down and notice $13,000 credited that we have right now for plowing fees. So then we're going to come over here to these columns right here, the debit and credit columns in the initial. You're going to, okay, hold on, let's slow down.
Yes.
Slow down. We're going to go ahead and put the dates, and we're going to put in for our explanation closing. Yeah, you can just put closing, doesn't
Yeah,
matter.
you can just put closing.
And then we're going to go ahead and put 13,000 debited to show that we're doing the opposite, to actually show that we're closing out this account.
Because remember, this is your normal balance of $13,000 crediting, right? So remember, when you have a debit and a credit, you subtract, and that zeroes this out, giving you a running balance of 0. Okay? And the reason that we're closing this out for the month is because we're getting ready for February, showing that only in January did we make that money.
I went ahead and added a little bit to the explanation. It was closing to income summary, just so you know where that's going for later on, and like later on in the future, if you look back at this video or at your assignment themselves, you can know that when you're doing closing, you know where that went. So now that we've closed out plowing fees, we're gonna have to go ahead and find income summary,
Correct.
which is right there, right above us, right? So we're gonna go ahead and put the date January 31st, and then showing that this is let's see.
Revenue?
Revenue. So closed revenue accounts. I usually like to put it very specific so you know what that number came from and which account it came from, right? So then since we debited plowing fees, we're going to go ahead and credit that amount here to show that that's how much we have now in the income summary. Now, don't get confused in thinking that income summary has a normal balance of credit now, because I put it over here as credit. Since it's the initial number, I'm just putting it there to show the balance there, that this is how much we have in our income summary, right? So now this is where it gets to the fun part of actually closing out our next temporary accounts, which is expenses.
Yep. On our expenses, okay? This is where we're going to put a placeholder right here. We're going to go ahead and show income summary right here on the first one. And then we're going to start putting in all our expenses, okay? And based on our chart of accounts, what do we have as far as expenses? All of that.
Basically all the ones from
All
our
the ones
income
we had
summary,
before.
right?
And you're going to find that on page 179. So we're going to start out with the salaries expense. And let's go ahead and just put the other one next. Advertising expense.
Oops.
Now I'll show you the madness to my method in a second. Then your telephone expense. Then your rent expense. Then you have your snow supplies expense. And your depreciation expense for office equipment. And then your depreciation expense for your snow equipment. Now, does it really matter the format? Yes and no. It depends. You should, by rules of accounting, follow your accounts as far as how they're recorded. But as long as you've got all your expenses there. Now, the reason why we're doing this is because we're first going to total up how much all our expenses are. We're going to put the information there, okay? But how much is our salary expense based on our ledger?
And spoiler alert, we technically already have the total.
Yep.
Where can
Where can we find all of this information? On what? Correct. If we go to your income statement, you already have all of the information that's there. And if you put everything in the same order on your worksheet only, then you can actually take it, highlight it, and copy it over.
Where was I?
Journal.
Start here on the first one, and then paste in the numbers, and then you're good. Oh
No.
Am I good?
No, you're not. It's not debit. You're going to credit them.
Credit. Oops.
And the reason why is because
Do that again.
these are, by accounting rules, they are normal balances as far as debits.
However, when we're closing them,
We're crediting.
and
So
then
now, what is this total? Going back to the income statement, this total is how much? Right, so we're gonna take that amount, instead of you having to do math all over again, you're going to then put this in and debit into the income statement. Income summary. So again, what we're doing is, we're now putting in that total of amount of money into the income statement, which now all your expenses are 4,000 what? $260.
$60. So now,
Because there's our temporary expenses, temporary accounts, and we're closing them out. So now, guess what we've got to do to each one of these? Close them in the ledgers. So, which means that you're going to go to your expense, and I think they're in what, ledger 2?
they're going to be starting from ledger
4.
4 to 5, I believe. But we'll go ahead and start with the first one, which is our debit to
Yep,
income summary.
Correct.
So I believe it's in ledger 3, right? Yes. So we're going to go ahead and go here, 31st, put in as explanation closed expense accounts. And you're going to debit that number, which is the $4,260, right? And so now we have these two numbers here, right? So initially I put the $13,000 credited here. So now that we have a debit versus a credit, what's going to happen? Subtract, right? And what's going to be our total number for this income summary? Correct. It's going to be the 8740. And now that looks a lot very much familiar, right?
From where? We found that in which financial statement?
Income statement.
Correct.
Out of the income statement, right? So basically what we're doing now is we're basically just journalizing all our financial statements into our ledgers and
summary,
journals. So now, with that notion of it being 8740 credited, that's showing that you have a net income or money or profit in your ledgers now. Like, you're actually showing that in your ledgers and books.
Now what we have to do is close out each one of the accounts. And you're going to start with your salaries expense. You're going to go up here,
Salaries expense.
and you're now going to close.
So then we're going to go ahead and click the dates, 31, closing as an explanation, and then you're going to do the opposite of what you have here, which is credits for that amount, 2350, to then make it 0. Now this is probably the only time where it's going to kind of get a little bit,
Harry.
yeah, I guess, frustrating.
Frustrating.
And what you could basically just do is just go down the line until you've hit all your expenses and just do the exact opposite on all of them of what you see, just to zero them out. Am I going too fast for anybody? Or is this alright? Closing. Dun, dun, dun. Dun, dun, dun.
Now, if you have any questions, please ask.
Feel free to ask. I'm full of answers.
No,
We're full of
no
responses.
comments.
Full of responses either way.
I'm not going to comment. Yeah, full of responses. There you go. That's a good one.
Lots of lies.
And he'll do different voices on his responses as well.
It's very simple to do. So ain't this lovely? Just going down the line, closing all our expense accounts. Now, when I was taking this class, I found this to be an absolute nightmare. I don't know why. I guess because I was the only one taking it, doing everything by myself. But not that bad now. I don't know why.
You've been doing it since last summer.
Been doing it for a year already. And that's it for now. We've now closed out our revenue accounts, and now we've just closed out all our expense accounts.
Now we have one last one, which is not the capital. Yes.
So now we're actually going to close our income summary number
Yep.
into capital. So now we're moving everything into capital now. That's going to be our final step.
We forgot one, didn't we?
Well, we're not there yet. We're on our way there.
Oh, that's right. I missed a spot here. Sorry.
So now, is everyone done with the closing of their ledgers on the expenses? Give me a nod. Give me a
See, give me a no. Give me I have no idea what you're talking about.
give me a scream. Something. Good. Mucho bueno. It's the only Spanish I know.
And tortilla. Don't lie.
A tortilla. It's tortilla. Everyone good?
Now, just looking at the little bucket that we've got here. All right. Remember, this is from our income statement, right? Revenue and expenses. So what was our total? 80 what? Again, notice what we're doing. So what we're doing is we're going to go ahead and put that into capital. Didn't we do that from our, we just do that when we did our statements? Yes, we did, right?
Right.
So now what you're going to do is you're going to then here show the debit of income summary.
Because now we're closing out income summary. 'Cause
Right.
We had a net income within that, so that was a normal balance of credit on income summary. That's the only time it'll become a normal balance in income summary is when you determine
That you've made money.
that you've made money or if you lost money. It'll vary on what side depending on that. For the most part, you would want it to be on the credit side because that's showing that you have money. So we debit income summary, and now we're going to go ahead and credit capital because we're now gonna increase our capital by this amount,
Which is what we did. Remember?
which is what we did in our statement of owner's equity, which is one of our financial statements, right? Yes. Yes, Tudor, yes. Closing income summary.
Summy?
Hey, I don't know what you're talking about.
Please, somebody save your stuff.
Quick, save it.
Please save it. We could get power outage and it's all gone.
All this work for nothing.
Now, we have to go to where?
We gotta
Our ledger. We got to finish this. So let's find then our income summary and see how we've got a balance in the credit side of $88,740. Well, we're going to, that's why you're debiting, that's why we're going to go ahead and debit. And again, when we debit the amount of $8,740, now we end up having a running balance of 0. So now we've closed that out. We're showing that we've closed out all the expenses, everything else. Now, once we went to capital, came from the income summary, because we made money, and because of the fact that we still have to go ahead and close out one temporary account, the other temporary account that we have to close out is what? Correct.
So now,
How much do we take out? Sorry.
teacher, wait.
Okay.
Before we get to the withdrawals, since we've already debited income summary, we're now going to credit our amount
Oh,
into
that's
capital.
right. Into capital. Sorry.
We cannot
I
forget to do the other half of every
the debit
transaction.
credit.
Always do your debits first and your credits second. So I've credited our income summary number or our increase in capital, which is at 8740, into here. So now what we'll do, we have a credit and a credit. They're matching, so we're going to go ahead and add them. And what do we have? I'm sorry? What was that? Loud and proud?
Shouldn't it be just 740?
No,
hang
not
on,
yet.
hang on.
Not yet. Almost
We're,
there.
we're not there yet. Right now, we're just putting in income summary right now. We're putting in our increase in capital so far. So, how much do we have right now within our capital increasing? What's 26 to 200?
30,000.
30,940? 39,000. What you said? 34,940,0. Okay. So that's in there, right? So now we're going back into that withdrawals. We still have that one more temporary account that we need to do, which is withdrawals. So now we're going to look for our withdrawals. Well, first of all, we'll go ahead and type it in our journal. So what we're going to do is we're going to debit into capital and credit our withdrawal. And now why are we crediting our withdrawals? Because withdrawal has a normal balance of a debit. So you have to do the opposite in order to close it. And what is that number that we had for withdrawals? It was the $8,000. And the way you can check yourself on this is to actually look back at your
Owner's equity.
either your owner's equity or in your ledger itself.
Correct.
So now I'm going to go ahead and put here for our explanation down here is to close withdrawal account. So now we're going to actually perform this and actually show this in our ledgers. So we're going to go ahead and do debit first to our capital. So we're already here in our capital, and then that question that erupted out of y'all was wait, isn't that supposed to be only 740? This is where
You gotta get the 740.
you're gonna figure out and actually find that number, which because you're debiting now $8,000 into capital. So now we have a debit and a credit. So we're gonna go ahead and subtract now, right? Because they're opposing sides. To then determine the number of 26,740, correct? Or the 940? I'm sorry. 26,940, right? Yes, no, maybe so. But we're not done yet because we've only done our debit so far for that last closing transaction. We have to actually show withdrawals being closed out. So we have to go ahead and find our withdrawals, which is right underneath us, right?
Yep.
We're going to click 31st, closing to capital accounts. You're going to do the exact opposite of what you see here. It's a normal balance of debit. So you're going to go ahead and credit it to zero it out. And that is essentially how you close out for the month. That's how you do it. We're basically done with closing out all our
Closing
accounts.
out everything.
And to check yourself on to whether or not we did this correctly is we're looking at our capital here, 26,940. We can go ahead and go to our balance sheet that we did, and we have 26,940 right there. So now that's how we know how we did it correctly.
Now, save. Because we have one more thing to do. And then I'll give you guys a break. Maybe. I don't know. Please do. Yes. Last thing that we've got to do now is what we call a post-closing trial balance. Now, in the post-closing trial balance, what this is all about is showing then that
It's basically showing all the accounts, all the permanent accounts, or all the accounts that have balances
balances
still.
in it, okay? We've already closed out all the temporary accounts. So now the trial balance that we have have left with is all of our permanent accounts, right? So what did we say was a permanent account?
Capital. Accounts payable.
That's
Cash.
Basically all your
All
assets,
your
right?
assets. So we're gonna go down and we're gonna put in all of the ones that we find that are our
That basically have a balance within your ledger.
balance within the ledgers,
So you'll
yes.
start on ledger 1 and you're going to have cash, right? So cash was $49.60, right? So you're going to go ahead, come down here, put cash, and $49.60. Oh, here are those numbers again. $49.60 debited because debit is the normal balance for that asset. Let me go ahead and fix this really quickly. Perfect. And then you just continue on down the line.
with all your assets. Now remember, one thing that you need to remember also, go back to your post-closing. Now notice, on your post-closing, it's a trial balance, okay? Which means all of the accounts are going to be with their normal balances. So all the assets will be on the debit side. The liabilities or your payables are going to be on the credit side, because we're still going to end up balancing out, believe it or not.
Yes.
So we have accounts receivable, then we have prepaid rent,
And how much is that prepaid rent?
2,000.
2,000.
Snow supplies,
And that was one thing that I was noticing as well, is that some people were getting confused initially within their financial statements, thinking that those columns were debits and credits,
they're not.
but they're not. Usually, always is that financial statements will have a subtotal and a total area. It won't be debits and credits. Trial balances are not considered formal financial statements, so they only deal with debits and credits, left and right.
It's completely different than your worksheet, okay? Now, so the next one that we have is which one? Snow supplies, then we have office equipment.
Equipment is 12,000.
Now, right after our office equipment, we have what? Accumulated depreciation. $200, and again, that's because this is a normal balance for your accumulated depreciation. Then you're
Right
going
there.
to have your snow equipment.
Which is the 10,000.
That was 170.
Just to be sure, 170 right there.
What? You don't believe me? Why?
No, I just gotta check my ledgers, okay?
Why?
For the sake of the students.
Then we have our accounts payable.
Accounts payable. How much was it?
6,000. Yeah, 800. Then you had your salaries payable. Remember, all these balances we're getting from the ledgers. $150.
Right
There it
there.
is. And then we have Pat's capital. Which is 26,940. And now we total it out. And the reason that we do the post-closing trial balance is to make sure that everything is balanced with the assets, the liabilities, and owner's equity going forward. So what's our total? Yes, 34,260. Remember, just because you get 34,260 on one side, you still need to make sure that you get the 34,260 on the other side. Now this is the entire accounting
cycle.
cycle. From journalizing the first entries to putting everything into your ledgers, your journal, your ledgers, your worksheet, your income summary, and your post-closing trial balance.
Thank you.
All of it. Did you turn off?